Okay, let's get started with the second half of Chapter 8. In this chapter, in this part of the video, we're going to talk about equity financing. Now think back to the first part of Chapter 8 when I told you that debt financing is when a company borrows money that must be paid back. Equity financing is gained through funds that do not need to be paid back. One of those ways to have funds that do not need to be paid back is through the issuance of stock. So let's talk about stock. When stock is issued, when a company forms, let's start there. When a company forms, there's a given number of shares that are authorized. Some of those shares will be sold. Those are called issued shares. We also have outstanding shares, and the reason that is allowed, that is different than issued shares, is sometimes the company will buy back some of their stock. So they may have issued 10,000 shares, but they only have 8,000 outstanding. That's the number of shares that are currently held by stockholders. Little confusing, but those are three terms that you probably should be familiar with. Most stock, or in days gone by, most stock had what was called a par value. It was a nominal sum merely used for accounting purposes that had nothing to do with the sale price of the stock. It was so that we could account for the sale of the stock and any additional monies that we may have made. Let's say, for instance, a stock had a par value of $1. But on the stock market, when we had our IPO, we sold that stock for $20. The dollar par value gives us a method of properly accounting for the stock and the additional money that we received when we sold that stock. Some states now have a no par stock. They may require a stated value instead. Legal capital. Again, some states require a minimum contribution. I'm not going to get into all the details of which state requires what, because they're all different and it gets very, very confusing. But those are some terms you should know: par value, no par, and legal capital. What does owning stock give you other than a piece of paper with pretty print on it that says this is your stock certificate? It gives you ownership in the corporation. Because you own stock, you are an owner of the corporation. As an owner, you have the right to vote on matters concerning the corporation. When there is an annual meeting and various things come up before the group, you have the right to vote on those things. You have the right to vote for the president, the CEO, the board members. You have some rights. Stock also gives you the right to share in the distribution of earnings. What do we call that? We call that dividends. And we've had already some accounting issues where we've paid out dividends. And owning that stock gives you a right to those dividends if in fact they are distributed. If the corporation should cease to be in existence, then you have a right as a stockholder to share in those assets upon liquidation. I will tell you, though, that it's very rare that there's anything left over to give to the stockholders, but one can always hope. There are two types of stock that we generally talk about. The one that we're almost all familiar with, and if a corporation has only one class of stock, it is always common stock. Each share has equal rights, has voting rights. On the preferred stock, which some companies will have a preferred stock, generally sells for a little higher, has a little more value. They have preference. Anyone that owns preferred stock has preference over common stockholders. They have the first right to any dividends and any asset distribution upon liquidation. So us common stockholders really probably will get nothing. Generally, the dividends are stated in either a dollar or monetary terms, a dollar amount, or as a percentage of the par value. But for either type of stock, dividends are not guaranteed, period. There are several requirements before dividends can be issued, and the board has to authorize it first. Now, we all hear about the stock market and the price of various stocks. How is that determined? How do we know why stock is sold at the price it's sold for? There's a variety of factors involved. The condition of the company. How's it doing? Is it making a profit? Is it growing? Does it have a good record of paying dividends? All those things play into how high the price of that stock may be set. And remember, the market sets that price. It sells for whatever someone is willing to pay for it. And if the company is in great financial condition and has a great future in front of it, then the chances are the stock price will go up. And as I said, if it has a good future, if the investor can expect that their earning power is going to either continue or continue to grow. And of course, we have to take into consideration the economic conditions. If the economy is in a downturn, the price of stock is going to go down because logically the corporation is not going to be able to continue at its current rate in most conditions. All right, so let's look at this. We're going to issue some stock. Now remember one other thing here. The only time a corporation issues stock is at its initial offering, that IPO, initial public offering, because once that stock is sold and is in the hands of stockholders, the corporation has no further control of it. It is owned by someone else, and that someone else can buy and sell that stock as they choose. So the only time that we're going to issue it is at the initial offering, or if we choose to take some of the authorized stock that has not been previously issued and make a second public offering. So in this case, we're issuing 2,000 shares of $1 par value common stock, which is selling for $55 per share. Okay, you can see that difference. That dollar par value really has nothing to do with the market price. Now let's see where it has something to do with the accounting. If we're selling it for $55 per share, we're going to receive $110,000 in cash. So we'll increase our cash. We're also going to increase our common stock for the 2,000 shares at $1 par value. So you see we've only increased common stock for $2,000. The balance of the cash we received goes into an equity account that is called paid-in capital in excess of par. So do you see how that works? The accounting use of the dollar is to say what we receive for common stock, and then the additional is additional paid-in capital. Sometimes a company will buy back their stock from the marketplace. This is stock that has been issued and then purchased back by the corporation. There's reasons for it, and we'll talk about those. But the balance in the Treasury stock account, which is a separate line item in the equity section of the balance sheet, is reported as a reduction of equity. Because we bought it back, we spent some of our equity to purchase it back. So it reduces our total equity. Sometimes a corporation will buy back stock if they're issuing stock dividends or wanting to sell stock to their employees. Or they may issue those stock certificates as bonuses. And this one always gets me. The company buys back its stock to show that it values the stock and that investors should also value the stock. I don't know. That sounds a little illogical to me. It seems to me if a company's buying back its stock for reasons other than being able to sell or give it to employees, it might be because it's not selling too well in the marketplace. Now, let's look a little further here and talk about how we account for both cash and stock dividends. We've dealt with cash dividends along the way. A cash dividend must be authorized by the board of directors. A stock dividend must also be authorized by the board of directors. The difference between the two is one's paid in cash, one's paid in stock. What is a dividend? It's a distribution of the earnings of the corporation. You know, when we do those profit and loss statements, we look down and we see our net income. Well, the owners of the company want some of that. That's their money because they own the corporation, the stockholders. So they get some of that income by distributing dividends. A cash dividend is the most common form of dividend, and there are three conditions that must be met. There must be sufficient retained earnings. Go look at your balance sheet to see what retained earnings are. That's all of the profits and losses of the corporation to date. There must be sufficient cash. Can't pay a cash dividend if you don't have the cash to do it with. And the board must authorize it. There are some dates involved with the dividends. The date of declaration, that's the date that the board votes and says, yes, we're going to pay a dividend. The date of record. Everybody that owns stock as of that date will receive dividends. And there's kind of a nifty thing that goes on between the date of declaration and the date of record. Sale of stock between those dates is tagged with a note that's it's selling with dividends. People are generally willing to pay a higher price for that stock because they know they're going to get the dividend. So in this case, if I bought my stock on January the 9th, I will get that dividend even though I've only owned the stock for one day. And then the date of payment. Of course, that's important because we want to know when we're going to get our money. All right, so we're going to declare a cash dividend on December 1st for payment on February 2nd. What do we need to do with this? They've decided to pay on the preferred stock $2.50 per share, and on the common stock 30 cents per share. So we're going to pay out $42,500. Because as of December 1st, we owe that amount of money. It becomes a liability on that day. We owe it. So on December 1st, we'll make an entry and we will have a new liability account called dividends payable, and we'll reduce our retained earnings by the amount of dividends to be paid. You can see from this on the 1st, December 1st, we're going to record dividends payable and cash dividends. Nothing on January 10th, that's the date of record. There's no accounting entry involved. And then on February 2nd, when we actually pay it out, we'll decrease our cash and decrease our dividends payable. Sometimes a company chooses to distribute stock to their stockholders instead of cash. Same requirements except for sufficient cash on hand. There must be sufficient retained earnings and a formal action by the board. Now, the difference between a cash and a stock dividend is that a stock dividend does not change assets, liabilities, or equity. There's no distribution of cash. There's no liability to distribute at a future date. All we're doing is transferring or reclassing some of our retained earnings to issued stock. If we're transferring less than 25% of the outstanding shares, we use market value per share for our accounting entries. Okay, now let's look at how a stock dividend affects the overall picture. We have 10,000 shares outstanding. We've declared a 6% stock dividend. Even though each shareholder is now going to own more stock than they did before, it's not going to change their share, their proportionate, their percentage share of the total stock outstanding. Because now we had previously 10,000 outstanding, and with the 6% dividend, we now have 10,600. It went up 6%, the total shares outstanding. I still own the same proportionate share that I owned previously, because my stock went from 1,000, or 10% of the total, to 1,060, which is now 10% of the total shares outstanding. What's a stock split? Well, that one share of stock that you owned now becomes 2 shares of stock. That's a split. But that one share of stock that you owned at $1 par value now becomes 2 shares of stock at 50 cents par value per share. Try to say that 3 times fast. So a corporation can split their stock, but the overall picture, the overall par value, does not change in total. Most of the time, this is done when the stock market price has become so high that very few people are buying and selling that stock. So it reduces. Let's say I bought stock in some corporation a long time ago. I bought it for $50 a share, but it's now selling for $300 a share. Well, I'm not going to buy any of that. I don't have $300 to spend on stock. But if they do a 4-to-1 split, now that's selling at $75 per share, even though each share is only 1/4 of what it used to be. Stop and think about that a minute. It will make sense. So before the split, had 4 shares at $100 par value. For $400 par value, we did a 5-to-1 split. So now there are 20 shares at $20 par value. We still have the same $400 in par value. And just as the par value will split, generally the market value will split pretty close to the same split as the shares. So let's look at financial statements with equity section. We've talked about the liabilities, and that current liabilities are due within 1 year. We've talked about long-term liabilities due more than 12 months from now. And in our equity section, the equity section is part of the balance sheet, and it details the changes of equity. On the balance sheet, they're given in a very compacted form, but there is a secondary statement that gives the detail of any changes in equity. So here's an example of a balance sheet. As you can see, we have, this is just the liability and equity section of the balance sheet. You see all of our current liabilities, our long-term liabilities, and note the notes on our bonds. It tells that they're 8% bonds due in 15 years and what the market value is. And then we get down to stockholders' equity. Now this is a bit more detailed than what we've been working with up to this point. You see that we have preferred stock. The 10%, that's the percentage of the dividend. The par value, how many are authorized and how many are issued. We did the same thing for common stock, except there's no notation about dividends, because those generally are not written into the stock. Those are determined by the board of directors. We have the additional paid-in capital and our retained earnings. We have a total, And then you see we've apparently purchased back some stock. So we have treasury stock that we're going to reduce our equity. And then we have our total stockholders' equity. Now, there is a statement of stockholders' equity that gives more detail. Why did it change from last year to this year? And in this case, you can see that we issued 500 shares of common stock, 500,000, and we have some additional paid in capital. We paid out dividends on both preferred and common, and the company had a nice net income of $850,000. And we repurchased some treasury stock. So you can look through here and see the detail as to why our stockholders' equity changed from last year to this year. Earnings per share. Oh boy, another ratio to learn. We're going to measure the income earned by each share of common stock. And it's a probability measure. Earnings per share is calculated by taking net income minus preferred dividends and dividing that by the number of common shares. Corporations generally make projections each quarter and annually. And it's important that managers look at those projections and look at those planning to see the potential impact of any decisions they might make on the earnings per share, because most stockholders will look at that number first when determining if they're going to purchase stock. This is an example of some different financing plans. In Plan 1, all of our financing was from issuing common stock. And if you look down through here, you will see that our earnings per share is 60 cents per share. Now, the reason for that is because we have so many shares outstanding. Look at Plan 2. We're going to issue some preferred stock and issue some common stock. So our common stock, we issued $2 million, or we received $2 million for that, and we received $2 million for our preferred stock. Our earnings before interest and income tax does not change. Our income tax does not change. And our net income does not change. But look what does change. We had to pay dividends on that preferred stock, so we have our dividends. And we have $160,000 available for dividends on common stock if we choose. And we take that, our net income after dividends on preferred stock, and divide it by our common shares outstanding, and look at that. Our earnings per share has increased to 80 cents per share. Why is that? Because we have half as many common shares outstanding, because we chose to issue both preferred and common. In Plan 3, we're going to use some debt financing, and we're going to issue preferred and common stock. So our debt financing is going to be $2 million. Preferred is only $1 million, and common is only $1 million. That's 100,000 in actual shares. Now run down through. Our earnings before interest is the same, but we have to deduct interest for the bonds. So our income before tax is much lower, which means our tax is much lower. We have our dividends on preferred stock, which are half of what they were in Plan 2 because we only issued half as much. And we take the remaining number, our net income less our dividends, divide that by the shares outstanding of common stock. It's only 100,000 this time. And look at that. Our earnings per share is $1.28. So when a company is planning on how to finance the company, they have to look at all of these things. Yes, it would be great to finance the whole thing with equity financing because you don't have to pay it back. But our earnings per share is only half of what it would be if we use some debt and some equity financing. And the earnings per share is a concern only because we want people to buy and sell our stock and to continue to think highly of our company. Financial analysis. This has to be your favorite part. We're going to first look at the ratio of liabilities to total asset. Do we have enough assets to pay all of our liabilities? And if so, what's the percentage? How much of our assets are we pledging to our liabilities? How much of our assets are financed with debt? If the ratio is high, then the company is probably financing its operations with mostly debt. That's called a highly leveraged company, meaning everything they own would have to be sold to pay off the debt. And if that ratio is high, they're probably not going to be able to borrow additional funds. This is the formula. Total liabilities divided by total assets. So let's look at Lowe's. Total liabilities divided by total assets, we have year 1 and year 2. In year 1, it's 46.3, and in year 2, it's 50.7. What this says is that in year 1, less than half of the company's assets were financed with debt. In year 2, it crept up slightly to 50% of their assets. That's still a fairly good number. But it is going up. Now, you cannot just take a ratio and say, oh, that's good or bad. It's bad because it's going up. You need to know the reason behind it. Perhaps they financed a new building, or perhaps they bought a lot of new equipment. There may be a very good reason for the increase in the ratio. We also look at the ratio of liabilities to stockholders' equity. So we take total liabilities and divide it by equity. And here's the same example from Lowe's. In year 1, it was 0.86, and in year 2, it went to 1.03. This is implying that the company has financed its operations mostly with debt, almost equally with debt and equity financing in year 2, and slightly more in equity in year 1. Price-earnings ratio. This is looking at the future earnings of a company. This is taking something that is outside of the company books and developing a ratio. The market price per share of common stock divided by the earnings per share of the common stock. So we need to look outside of our accounting records in order to calculate this ratio. So we have the market price, year 1 and year 2, and the earnings per share. As you can see, the ratio is much higher in year 2 because our market price is much higher. So this is an assessment that for Lowe's, its future earnings potential is pretty good. And seeing that number increase is always great for the market price of stock. And with that, we end Chapter 8.